Welcome, everybody. Welcome to our Hindsight is 2020 session. I am Joyce Ripianzi. I'm a partner in charge of the Managed Accounting Solutions Division for the nonprofit sector. And we provide virtual, or mostly virtual, outsourced finance accounting functions. And in that, I provide consulting CFO services. And I'm here with my two teammates, Lauren and Amy. Lauren?
Hi, I'm Lauren Duplin. I'm a director and consulting CFO in our Managed Accounting Solutions practice, specializing in nonprofits.
I'm Amy Staunton. I am a consulting CFO, also in the Managed Accounting Solutions practice, providing services, outsourced accounting services to not-for-profits.
Here in MAS, we have a lot of exposure to the best and worst practices, and today we're going to walk you through some of the thoughts we have surrounding some of those practices. Some of the items we bring up today may seem obvious, but we continue to see them, and so that's why we think they're worth repeating and talking with you today about them. The first topic we want to talk about is cash flow management. So I know this has already come up today in a couple of the different presentations in terms of that this is an opportunity area that we continue to see with nonprofits. This is a big risk analysis area that nonprofits need to take a look at in terms of how they want to manage cash. The first piece of this is really identifying what are their cash objectives. Do you want to be focusing on returns? What are the risks in the different funds you have? What are your cash flow needs? From there, you want to move on and look at what your current policies and procedures are to evaluate what those are. We know that this is definitely an area that people recently felt a lot of impact from the Silicon Valley Bank issue, where they had limited availability to access those funds in the short term. And I think it caused a lot of people to look inwardly and say, what kind of policies and procedures do we have to periodically look at our balances and see where those are and what type of institutions. From there, you want to identify if you have areas of improvement. So for example, if you've identified that some of your cash objectives need you to have additional funds in short-term vehicles, have you looked at ways that you can diversify your banking relationships? From there, it's important to think about monitoring and reviewing and ongoing changes that are happening. For example, you may need to revisit the policy if there's a bank merger or if there's a significant increase in your cash balance for any reason. A lot of organizations create these policies and then don't think about the fact that they need to be revisited as circumstances change throughout the year. So I think, Joyce, I don't know if you want to add some comments on that. I know you've had a lot of clients that reached out to you after the recent Silicon Valley Bank issue and had a lot of conversations with clients about this, which I'm sure we all have.
Sure. Just to wrap everything up that you've heard today is your clients are reaching out to us to do a risk assessment over their cash balances, and they are reassessing the banks they're using, what the FDIC insurance is, and what they can do to make sure that they're mitigating any possible risks. So we are seeing a lot of banks come forward and offer what we call CDARs or ICS, intra-fund cash services, where they're basically using on the backside many banks to separate the money and get you the FDIC insurance. So if you haven't done a risk assessment over where is your liquid cash, this is the time to do it. And if you have any questions, you can certainly reach out to us on that. So with that, we're going to talk a little bit about debit and credit card risk. So what we continue to see, again, this might be one of those obvious things, but we continue to see issues around this. We recommend that our clients do not use debit cards. So debit cards create a direct access into bank accounts. And if the information is compromised, it puts your entire cash balance at risk. So we're always recommending to clients that we prefer that they use credit cards. It creates a buffer between your cash and the expenditures of the organization. So if you haven't established a strong credit card policy, you should be doing that. And that's lessons learned over the past year. I don't know if people realize that the laws are different for credit card use versus bank for ATM card use, and you don't have the same protection as an organization. You don't have the same amount of time to review those transactions and possibly target a fraudulent transaction. So you should be looking to establish credit. If you haven't done that yet, we have avenues or people we can introduce you to that can help you establish your very first credit card. But a credit card policy needs to be established to make sure that everybody in the organization understands how they should be used and when they should be used. But also from an accounting standpoint, we're more concerned with how those transactions get captured as quickly as possible into the general ledger, that they get tagged appropriately and accounted for appropriately. So there are lots of great apps that are being developed that can connect over to your general ledger to help you manage the multiple credit cards. We also never recommend sharing credit cards. We want every single individual who's using a credit card to have their own credit card so they can be held accountable and that they're not sharing it. So when something goes wrong, you know exactly who the person is that needs to be better informed about what the credit card policies are. So if you need assistance creating any credit card policies, we can certainly help with that. Now we're going to move over to Amy on budgeting.
Great, thanks. Thanks, Joyce. So I know a great process to setting your budget is to take the previous 3 years of your activity and then assess that, add some kind of a premium to increase that, and then that's your budget for going forward. I just want to point out that if you are doing that 3-year look back, now we're almost at the point where there's not pre-pandemic activity included. So everything you're looking back towards includes some form of pandemic, whether it was impact on your funding, impact on your spending, but there's definitely some form of impact that you've had on your performance at that point. So we really need to have you look at each one of your line items and just really think about, where are we at now? For example, rent. So is rent at the same level that it was pre-pandemic, or is a lot of your workforce remote? Where are you at with travel? Are you returning to pre-pandemic levels, or are you always going to be a bit of this hybrid? But you really need to put a lot of thought into each of those line items at this point, and not just rely on past historical information, or even going back 4 years. Is that even really relevant information anymore? We really want people to look at the top line revenue also. I think sometimes we hear clients that say, okay, these are my expenses, and so that's what I need to raise. But is that really realistic? And so just really think about your spending, and is that realistic in relation to your fundraising goals? Also, there's been a lot of wonderful pandemic funding that our clients have received. So you've received PPP income, you've received ERTC, hopefully, all the acronyms. You've received all the acronyms, and possibly even ARPA funds. What of that is continuing, and how much have your results the past few years shown net positive income because of that grant funding? And what happens when that grant funding is taken away, when it ends? And is your regular fundraising, is that at a level it needs to be to sustain your expenses? You also want to think about spending your time on the right areas of the budget. So sometimes people get too granular, where they will look at a thorough benefit analysis by employee. And that takes a lot of time, but is that where your time is best spent? Or should you just look at a flat fringe rate and spend your time assessing other areas? So just make sure you're getting granular in the areas that really give you the most benefit in your budget. You want to be thinking about your long-term, your long-term 2 to 5 year plan. So what are your upcoming capital campaigns? What are your upcoming major repairs that you will need? We've heard a few speakers talk about technology. So obviously you will have some technology needs over the next few years, and just making sure that your current spending and your current fundraising is keeping those long-term goals in mind. I want to mention one thing about how you do this. And so you will hear next from Dawn and from Robin about some great tools that could be used to prepare budgets. And those are really helpful. For some people, those could be cost prohibitive. And so Excel is a great option as well. Just one caveat, one warning with Excel, because I've fallen into this trap a few times myself. Say you download your statement of activities from QuickBooks, and you have it all set up in Excel. You add a line, and then you just keep going because, I'm going to hire a fundraising consultant this year. So you add that line and then keep going. Those downloads from QuickBooks are not great as far as the formulas. They're not a sum of that column. They are adding this cell plus this cell plus this cell. And so if you add a row, it doesn't always pick up that new row, and you have to be really careful with the formulas. One thing you can do is, when you think you're close, put that budget into QuickBooks, if that's a software you're using, and just make sure that your balances are coming out the way that they need to be. And then finally, I just want to mention the frequency of your budget, as far as how you break that down into the periodicity. And I'm sorry, I can never say that word right. But what I mean is that if you are a school, are you doing your budget based on 12 months? Or are you doing that based on the school year? Because some of your expenses, like your rent, if you have rent, that would be 12 months. But your tuition is only going to come in for 9 months. Your certain expenses are only going to be over 9 months, and so just make sure you're setting that up at the right frequency. Or if you have a big gala in the spring, you're just a traditional not-for-profit, and you have a big gala in the spring. Make sure you set up your budget then on a monthly or a quarterly basis, so it doesn't show that all year long you're behind in your fundraising when you know that fundraising is coming. Joyce, do you want to add anything to that?
Sure. I think the highlight here is that things are no longer same as last year, right? We've come out of a pandemic. What we're seeing the clients are spending a lot of time on is analyzing what are we spending money on and why are we spending money on it? Really questioning decisions that were made pre-pandemic, why they continue to pay for things that they're really not utilizing properly. So I think budgeting is a time to not only predict what you're going to spend, but really put a hard look on, are we spending money in the wrong places and we really just haven't questioned ourselves and gone back to the drawing board. So again, more to come on budgeting in the next session. I think we're going to go to a poll question now. So what are you using to create your budget? We're curious. We'd like to know. And for the sake of time, we're just going to keep continuing while you guys take that poll. We're going to continue on to Lauren, who's going to talk to us about grant and contracts language.
Great, thank you. And I guess just to close out on budgeting, I think one thing that we've noticed a lot with our clients is that, as you said, Joyce and Amy, there's a lot of opportunity that people are finding when they comb through the budget. I think one thing we've seen a lot of is unused items in office space. Maybe you're paying for phone subscriptions and things like that that need to get addressed in your current year budget. So just to kind of close out the thoughts on that. Right now, we're going to talk a little bit about grant and contract language and how that impacts financial accounting. So we often, when we're working with nonprofits, find that there's a gap or an issue with communication between development and finance. And when I say that, I mean that it can happen at the beginning of a gift or once a gift's already been accepted. But either way, what happens is the communication is often not accurate or happening at the right time. So, when possible, we want all of our clients to develop a gift acceptance policy. That's the best way to make it clear in terms of what your expectations are around gifts that the organization is going to accept. For example, a minimum dollar threshold for a specific endowment account, policies around multi-year commitments and what you want in writing and what you want as a commitment from the donor if that's the type of gift you're going to get. In addition, I like to call it counting versus accounting. Development tends to count gifts differently based on the year that they may have fundraised the gift versus, if you have a multi-year pledge, development is going to spread that out over 5 years. But from a cash perspective, that will impact the financial records. But from a GAAP accrual base, that would have been all recognized in the first year. And so that's why we really feel like having a good gift acceptance policy can help navigate this complex area and make sure that you're able to fully reconcile between your two sets of records. Recently I had something come up with one of my clients where they accepted what I'll call a complicated gift. They did some fundraising with a donor who decided to give them a gift for a restricted purpose that they're not actively fundraising for. And, it was a very generous gift, but it will not cover the whole project. Attached to that, the donor said, can you please invest it until you're going to use it? So now the client is charged with, placing this into their investment portfolio, now having to allocate income to this and track it separately. And it's become a little bit cumbersome from an accounting perspective. And this is where I say that if, a conversation had happened sooner in the process, they may have been able to navigate or guide that donor in a different direction for the gift, which may have made it a little bit easier from an accounting perspective to track throughout the period. This again is an area that we see come up a lot. There's a lot of gray area here. And so it's definitely an area that we find we get a lot of questions throughout the year, and especially when we're working with new clients with complicated gifts.
So certainly, Lauren, revenue recognition continues to be the most complicated area for accounting and probably will continue to be only second by lease accounting standards that we heard about this morning. It is an area that is very complicated, and I know this because I have to answer questions of people that have a lot of years of experience. So when areas get gray, it creates more complexity. And so understanding all of your contracts and your language in basically having a grid that lays out everything, all of your funding, how you're accounting for it. Is it 606? Is it 958? And having a map of your revenue source is something that we usually start with when we bring on new clients, because we feel there's always a lacking in that area or that understanding around revenue recognition. So with that, we're going to head back over to Amy, who's going to talk about the things that we've been experiencing on duplication of data collection.
Thanks, Joyce. This is something that we continue to see over and over again. We call it getting your rows and your columns confused. That is not a technical term, but that's basically what's happening. So it is when somebody takes their GL and they have the same expense listed multiple times. So you might have a section for G&A, and you have your expenses, your expense accounts listed. Then you have an account, a section for fundraising, and you have those many times, often the same account numbers, account names listed again, and then programs, and you might even have multiple programs. So you have salaries listed under each one of those sections. That actually makes it hard for you to assess your overall organization and what are your total salaries. You know, when you get your audit or your review done, it's all in total, but you might not be preparing your closes or doing any of your analysis on that level of detail. So you can add a dimension in most accounting softwares. And so for QuickBooks, I'll just continue to use that example. You add classes. And so you have a class for G&A, a class for fundraising, a class for all of your programs. Then you just record salaries to your GL, and then you can add the class to tag it to get it out to those columns. And the benefit to that is that when you need to run funder reporting or grant reports, you can actually run a P&L based on just that class without having to do spreadsheet gymnastics, as one of my clients calls it. You can further add another dimension in software. So you can not only tag the class, but you could also tag the customer. We usually call the funder the customer. So then I can run a P&L directly on that funder. So when somebody needs to have a report, I can pick the random date of that grant report, and I can say for this 2-year period, here's the P&L information that I want, and it's all there. Again, that allows you the benefit of seeing your expenses on your overall organizational level, but then also being able to break it down into those dimensions as needed. One reason, it's another benefit to doing that is sometimes when you're recording those expenses, say you have postage in many of those different categories, but you just buy the postage once. When you record it, having to split it into each of those categories delays you in recording it to the general ledger. Another option when you're using these classes is you just record it to your postage expense. You can record it to a class that's titled to be allocated, or that class could be not specified. And then at the end of the month, you could go ahead and you could allocate all those. Maybe some of those expenses follow salary or follow a certain allocation. You could just do them all at once, but it allows you to record them to your overall GL, so you at least have that expense captured. So this is something that we see often. The other thing I want to mention too is we do often see a lot of expenses captured into an account called program expense or grant expense, and that's too general. You really need to have the expenses listed under their natural classification, and then you can tag the appropriate program as needed. But that helps you get everything into the account that it technically follows its natural classification, so it's in the right area of your GL. Joyce, do you want to add anything to that?
Excellent, Amy. It's all about efficiency. When we start working with a client, we spend a lot of time on creating efficiencies around gathering data, how to tag data, how many dimensions to use. But it's amazing that we have to continuously fight that battle. There are people throughout the entire organization that are constantly trying to get you to add new accounts, a duplicate account. So it has to be something that you control closely, and you understand that maybe it's just a change in how we issue reports, but we shouldn't change the way we're capturing the data. We should have already figured all of that out in such a way that it's most efficient. So with that, we're going to go over to Lauren now, who's going to present some information around financial reporting.
I think that's a really great segue from duplication of data effort, because I think we've all felt the impact of that when you go to take the next step, which is to actually generate the reports, right? If you have an overcomplicated structure, it can definitely make it a lot more difficult. And I think this ties in with what I'm about to talk about, which is people not using their financial reporting module, which we meet a lot of new clients that are in this position where they're querying data from, the software, and then they're putting it into Excel and they're manipulating it or massaging it, however you want to call it, in order to get the financial reports that they need for the closing period. Looking at some survey results from nonprofit time that was conducted with some SAGE clients, 42% of respondents said 80% of their time is spent on tactical and routine tasks. And 72% of the people answering the survey said that financial reporting was the top priority. So what that says to us is that people want to be doing more financial reporting. They want to be getting the data better, but they're having difficulty. And I think part of it that we see very frequently is that people are not using the system the way it was designed to be used. And it is not set up in a way that facilitates financial reporting right out of the software. Making supplemental reports outside of the software is always dangerous. It's prone to mistakes and errors. It can be difficult for transition if you need somebody else to cover that while someone's out on vacation, or if you have transition in the position. And it can be difficult for training everybody and to be able to get consistent and accurate data. Oftentimes we hear the feedback that people don't want to spend the time working with their financial reporting module or finding a supplemental module to work with because they think it's expensive. But the reality is that the expense of having your staff spend a lot of time creating these reports is actually likely more expensive. And I think after we all saw the robotic process automation demos that Facilis just did, I think we can all agree that there's probably a better solution that you can get to in terms of financial reporting. So, when we think about this, like I said, we consistently see examples where clients are creating manual reports. Maybe they have two entities and they're in separate accounting functions and they're exporting data, creating a financial report, doing manual eliminations. And really, it's prone to error once you're working with Excel and you're not allowing automation to come through. So we really try to focus on having clients either look to see if their system can work with the data that they need. Maybe they can reset some of the dimensions they're tracking in order to get the reports they need, or if there's opportunity for sort of a supplemental report module or other opportunities for robotic process automation in order to generate these reports. Because again, anytime you have human error or exporting and changing data, it really sets everyone up for potential disaster. I think we have a poll question coming up next that we can pull up, and I think we're going to keep moving. But the question we have is, do you get the financial reports and data you need on a timely basis to run your organization? And Joyce, I think you're going to be doing compliance, unless you have any other comments on reporting.
Yeah, I think the number one thing that happens in our division of AAF is that people come to us wanting to change general ledger software packages because of the report feature. And when we find out that they're actually not utilizing the report feature of the system they have. So an assessment is done, and there are people throughout the whole organization at AAFCPAs, including the team members that are following us on a presentation, that can do a wonderful assessment about, do you have the right tool before you change tools? And if so, we can help you find the right tool. So financial reporting continues to always be one of those issues that we face. So if we go to the next slide, is about compliance requirements. In an ideal world, everybody's going to do what I'm going to suggest. And I hope that if I can touch just 10% of the people on this call, that they put this on their calendar of things to do, it would be wonderful. But I think every organization needs to have a compliance checklist / calendar. When we talk to organizations, they continue to come to us with issues around something that was compliance oriented that got missed during the year. There are annual requirements, there are federal requirements, state, city, regulatory requirements, and multi-state requirements. So if you start listing out all of the compliance requirements you need to follow as an organization, and all of the things you need to remember to do, whether it's when is my tax return due, when are my annual reports with the Secretary of States, how many states am I in, what are the filing requirements, you're going to find that it's a very long list. And what we've seen in our industry is there's a large amount of turnover in the accounting staff at nonprofit organizations. And this is where things fall through the cracks because there isn't a comprehensive checklist as to what needs to be done. Someone earlier, I think it was Josh, had mentioned, the IRS is focusing on on employee versus contractor carve out, and are you following the rules? And so this is definitely something that we continue to have to bring up to clients, and we do it on an annual basis. And this is something I would put on the request or the compliance checklist, that I need to do an annual assessment when I'm doing my 1099s. Do I have all my W-9s, my W-8s? But more importantly, are there people getting a 1099 that are supposed to be receiving a W-2? We also see a lot of issues around multi-state issues, and we have SALT specialists here at AAFCPA. SALT stands for State and Local Tax Specialist. There's a lot of issues for nonprofits when you're serving multiple states, because there are not only payroll-related issues, where are people living, where are you doing business, but there are regulatory reporting requirements over whether I'm just doing business in a state at the Secretary of State, or whether I have to file for some sort of a solicitation certificate in that state. And here in Massachusetts, that's one of the things that we find can fall off the radar screen for certain people. Also, you saw a segment on employee benefit plan auditing. You have 401k or you have 403b compliance requirements that all fit into the accounting model of things that you need to do to cross your T's and dot your I's on an annual basis. That should also be on this checklist. Recently, we had a client that failed to respond to a workman's comp audit request. And it's very painful when your insurance company is asking you for workman's comp information to make sure that you're not paying too much or too little for workman's comp. And that's another great example of something that should be on the required checklist, because it happens annually. And if you fail to provide the right information, they can just assess you with additional workman's comp insurance premiums. So there's also compliance requirements that clients will hit for the first time that they forget about. And that might be, I had federal funding for the first time and I need a uniform guidance audit. I am in the state of Massachusetts and I have to file a UFR for the first time. So also including in your checklist, things that might appear based on your model, things that are on your horizon should also be included in that list. So I don't know if either of you have any comments on compliance requirements. If not, we can go over to Amy, who's going to talk to us about too much paper. Once again, we're still talking about too much paper.
We are still talking about too much paper. People really seem to love their paper. So this is still a big issue that we continue to see at our clients. It's still a big issue in the industry. It takes a lot of space to store all that paper. It takes a lot of time to file that paper, to touch that paper, to move it from person to person. If that paper is coming in the mail, that takes a lot of time to receive it. If you're still writing manual checks, just think about the time when it takes for you to receive that invoice in the mail, write out the check, maybe have to get an authorized signer to sign it, put it back in the mail, and have the vendor receive that. That takes a lot of time. We keep hearing about work harder. No, that's not what it is. Work smarter, not harder. That's the saying. And so I think there are some smarter ways to work in this area as well. If you can move things electronically, it allows you to take vacations because others can cover for you. It allows people to work remotely when needed. Maybe a sick day, you don't want to be around others because you're contagious, but maybe you're feeling okay and you could get some work done. Having things electronic allows that. Of course, we want people to take care of themselves, but if you don't want to waste a vacation day, you can work from home if you're not touching too much paper and it's electronic. There's no value added in shuffling paper around. If you even think about your annual audit, it's so much easier to just be able to have a PDF that you already have saved on your system and email that over to upload that file to the auditors. It makes their job easier as well. I think that there is sometimes a fear from people of, if I stop doing this job the way that I'm doing this job and the amount of time it takes me to do this job, I'm not going to be needed to do this job anymore. And I hope we've made that point throughout the day that that's not the case at all. There's so much else that you could be doing rather than touching that paper. You could be analyzing your KPIs. You could be looking at your aged receivables and collecting some cash. You could be looking at new funding sources and getting additional grants. You could be looking at some of that budgeting we were talking about and the expense control and trying to figure out if there's some additional ways to save money. So I think there's so much else you could be doing with your time that the time doesn't go away by not touching the paper. That there's actually, it could elevate your role and find more exciting tasks for you to be doing. So for those on this call that maybe work with somebody who's a little bit resistant to that, I think that's the point to make to them, is there's a lot else that we could have you do if you weren't doing the job in this way. If you think about the movie Hidden Figures, I know that, people talk about that too. Computers are going to replace them. And we've all seen that computers just continue to enhance the job that we're doing and make our job better. So I think, there is the concern that there is some digital risk with hackers and with people getting into your system. And there are tools that you can use to protect your data. AAFCPAs has somebody who can help you with cybersecurity. There's cybersecurity insurance, and there certainly are ways to mitigate that risk if that's one of your concerns. But we just want to make the point that it's not adding value to anybody's role or to your organization by spending as much time as it takes to move the paper back and forth. That I think there's efficiencies to be gained and other tasks you could be doing. Joyce, do you want to add on? Oh, sorry, Lauren.
I was going to chime in. That's okay. I was going to say that I had a breakthrough with a client this year who was actually still doing their 1099s on paper, believe it or not. So they're actually going to Staples, purchasing the paper and doing the 1099s. And I think at first there's always a resistance, to your point, to switch to something electronic. There's that trust factor, learning curve. And she was amazed with how much more quickly she could get the 1099s done. And something that used to take many hours was much faster when you can just upload into a system versus driving somewhere, getting the paper, restocking the envelopes, all the stuff that you talked about, Amy.
Okay, so with that, I think we can bring all three of us back in for this. We continue to see a theme amongst all of the presenters here today about efficiency, working smarter, not harder, eliminating the way we used to do things, thinking about the new way we want to do things that are far more efficient, but use us in a way and use the personnel at clients in a way that is much more rewarding to their job. So when someone's not spending time, at a printer stapling something, they can be used to do some data analytics to figure out how to help the organization with the accounting information rather than just pushing the paper and processing the data. So we want to help transform not only our internal staff and our team members, but our clients' team members into the generation of the future that needs to be able to work inside of an electronic environment with speed and efficiency and be able to analyze data and use it to benefit your organizations and to throw out the way we used to do things that were very time consuming and really didn't add any value to what we were doing. So we are running behind, so we're going to try to end this segment a little bit early, but we are here to help. As Matthew talked about, it's about systems, peoples, and processes. It's our three-legged stool. We find that it's important that you balance that stool. And all of the presenters here today are having a question and answer segment. So if you'd like to submit questions, you can go ahead and do that. And we will all be available in a segment where you can join us. And so with that said, we're going to give back the extra time that we have because we're so efficient. We saved time and kick you back over to John Buckley.